Hey, European DJ. We're late this week, but how was your weekend?
So far, so good. Spring has started here, so it's really nice. And I've been, preparing a bit the garden and everything. But at the same time, I start to think also about spring cleaning my portfolio because there are a few stocks in there that, already in my annual report said like I might dispose of them. I sold quite some Apple in the beginning of the year, 1/3 of my position, and I have a lot of tax due on that one. So now may actually be a good time to get some of those that went down with the broader stock market, sell them so that I will be tax neutral and then redeploy the money to strengthen some of the other positions while not losing yield and avoiding a tax burden. So I think that's what I'm going to do in maybe even this week around Easter. Let's see how the market is. But anyway, it doesn't really matter, I guess, where the market is. But I would need to calculate a little bit like how much I would need to sell to make up for that tax bill that is due next year.
Nice.
But spring cleaning, so that's up and coming for me. How about you? You've been a bit busy lately.
Yes. I was in Italy all week, and that's why we didn't record on Friday. I got back to Waterford here. I would say late enough on Friday, and I'm just wrecked. It's just, do you know what, these business trips, everyone thinks it's all fun and nice. Sometimes it's hard work. But look, we're going all French today. We have 5 French stocks, and I think, do you know what, the French market for dividend stocks is quite strong. We could easily have picked 10 on this. So.
Yeah, I know. So we'll get back to that later, Derek, but I'm looking forward to this one.
Yes. What about news of the week? So I haven't been tuned into much, but I have obviously seen Trump and tariffs are still taking over everything.
I mean, it feels like we're living in the Twilight Zone. I mean, what a shite, what a shit show.
Yeah.
It's unbelievable, right? What's going on there? It's then tariffs on, tariffs off. Yesterday we heard that probably electronics like laptops and everything are excluded in telephones. So that would be good for Apple or one of my darlings, HPQ. Yes, so let's see how the market responds tomorrow. But it's really like, this is crazy. And now they complain kind of that they can't make 90 trade deals in such a short amount. I mean, there are 180 countries or so, and they just declare a tariff war on all those countries. Now they wonder, how do we process all of this? Come on.
Yeah.
It feels like a slapstick, yeah. I mean, whether or not the outcome is what the United States needs and make them better off, I mean, we knew that the direction generally of more and more debt and everything was not helping them anyway.
Yeah.
So you could make a case for, let's try it totally 180 degrees different. But I have sometimes a feeling that I'm watching a slapstick.
Yeah, I had an interesting conversation with one of our listeners on Instagram, and I don't know. I don't think Trump is as silly as he looks, and I think there's obviously a greater plan for this. What this is, I don't know. But one theory that was brought to me was they have to refinance. Was it $28 trillion in debt?
I don't know exactly, but
I don't know the money, but it's a lot of money, and he doesn't want to do that when the interest rates are high. So maybe he's trying to force interest rates low before he does this.
Yeah.
Look, I think there is a plan. It just looks messy from the outside. But from what I gathered, they paused the tariffs on Europe and rest of them. It was really China after that.
Yeah. I don't know anymore. That worked for one day. The stock market went up, I don't know, 9 or 10%, and then the next day it went down again.
Yeah.
I mean, it's unbelievable. But how do you keep your head cool? I mean, we've been speaking a few times about it, right? But have you been buying something?
No.
Are you buying in this week? No? You were just too busy working.
And honestly, I actually prefer that I was so busy because it's easy to get caught up in hype and let yourself run away. So being so busy, I haven't been on my phone much.
Yeah.
I haven't been on that. And the only time I get notifications is on the Giro when something drops 10%. And it gives me a notification. Other than that, I'm oblivious to it all, which is quite nice.
Yeah, so I have the same, although I do have time in the evening, right after work, to look at the stock market, just because my passion. But yeah, it's really simple. If you don't have a lot of money to deploy because it's based on your savings rate, then you spend it and it's spent, right?
Yeah.
So what I just try to do maybe is make a little bit smaller purchases so
Yeah.
that they can buy a few different stocks than the regular 1 or 2 a month. That's nice. But for me, this is just very exciting. It gives me the COVID crash vibes, which I have very fond memories about from a stock market point of view. So yeah, let's see about this one. I mean, it's a tricky one, right? Overall, you could argue like, and Sven Carlin is very vocal in that, and Ray Dalio as well. Like the stock market could go down another 50% if it would reverse to the mean of historic averages. Yeah. So, and I agree with that. That's just normal economic theory and stock market wisdom. Yeah.
Yeah.
On the other end, I mean, there are a few stocks now trading in a multiple that you wonder, like, is the market just mispricing it? Yes, sometimes there are some stocks where they have the whole supply chain in America as well for the American business, but they get punished like everything will come from China. Yeah, so I find this very interesting sometimes.
Yeah. Look, it's hard to know. I really hope selfishly my portfolio doesn't drop under 100K. I work so hard to get there. Just don't crash that much. But look,
Yeah.
once the dividends keep rolling, then we'll be absolutely.
Yeah, so I'm now posting on mostly on Twitter every day a dividend chart just to remind people why we are investing. They make us calm. Yeah,
Yes.
they're steady Eddie. Then there's my whole timeline is about tariff, and it's all about price action. And you know what? It triggers really the wrong emotion into people, at least those that can't keep their head cool. Yeah, it's so important just to stay the course, know why you're investing, stick to your strategy, because your strategy was the goal that you set to reach a desired outcome that should bring you to a nicer place than where you are today.
Yeah.
So I don't have a belief that, for instance, a dividend growth investment strategy suddenly right now because of the tariffs should be thrown in the bin. Yeah. So why change what you were doing?
Exactly. But maybe people are panicking because they see what happened in 2020.
Yeah.
And they might feel like it's the best way to get rich faster or accelerate their journey.
Yeah.
Whereas I'm not really in a rush.
No. And from that point of view, it feels like, from one time I spent some time on Twitter and then I spent time in the Facebook group. And sometimes that's day and night difference. If I come to the Facebook group, it feels a bit like being home. Like-minded people, they get joy out of this. They're just buying whatever they want, but all mostly focused on income, let's say. And yeah, it's a nice community.
Yeah. Let's stay with that focus on income and talk about dividend announcements. I think we have a couple here, but Procter & Gamble start off with a 5% dividend hike, which is not too bad. Tangar, ticker symbol SKT. And I have not so fond memories of this company. They were my first ever dividend cut, but they've had a dividend hike of 6.4%. Aon raises its dividends by 10.4%. I have my pension with Aon actually, so
I didn't know that.
And Fastel, ticker symbol FAST, raised its dividend by 2.3%. So, what do you make of those hikes? Anything stand out to you?
Well, I think it's nice to see Procter & Gamble continue to hike, right? I always look at them with one eye, comparing them to Unilever, and it's interesting that P&G can just continue to do this while Unilever just has been struggling, right? Now, we all know that Terry Smith from Smith Fund is very bullish on Unilever right now, specifically with the new CEO as well. And you would argue, like, with Unilever, probably the only way is up. That's very interesting to see how P&G just continues to grow the dividend. I mean, I'm saying this with a lot of admiration.
Yeah, me too. That's the one that caught my eye. Obviously, Aon is interesting for me because, as I said, I have a pension with them, and I actually never even thought of them as a dividend-paying company. But I must check it out for a little bit of exercise and see what I invest every month in my pension, how that would perform versus dividends received from Aon. That would be
I think Aon will do probably better.
Let's see. And if they do, I might have a word with my company. He said, I no longer want a pension. Start investing in AI.
Yeah. Buy their shares, not.
Yeah, nice. So today's all about French companies. So we have 5. We could have picked maybe, do you know what, at least 15. I said 10 earlier, but
Yeah.
I left out actually lots of different companies. But I might start with
No.
one.
Let's
Oh,
not
okay.
start. Let's
Okay.
start first talking about the tax. Yeah, the dividend tax. Yeah, no, we need to do it. We really need to do it. Because generally we get charged, is it 25% as foreign investors or 30% on the dividends?
I had 28 in my head.
28, yeah, something. Let's say something like that on the high end. The thing is, if you are foreign, you do have a right on 12.8% tax. It's just like, can you reclaim the difference? Yeah. Now we know that from the Kleine Kapitalist, he has an account at ABN AMRO, and they can do this for him. Yeah, so he gets the tax back. For most of us, I think you need to fill in the 5,000 or 5,001 form. It's not easy. Yeah, so I think that's an important disclaimer here. Like, depending on your own situation, if you're a Swedish investor like Ellen, they get everything back. I think he had 99%, 0.6 maybe reclaimed from all the dividends, foreign dividends, right? Because the Swedish banks need to do that, I believe, by law there. But we don't have, at least I don't have such an opportunity. So for me, I look at the yield after tax in this case, knowing that there will come some regulation one time, maybe by 2030, that I can get everything easily back. And I hope by then we can also get it back like 3 to 5 years from then, which is the dividends we're paying today. Let's cross our fingers for that.
Yeah, but come on, all this should be automated by now. Really should be.
And 2025, of course. Come on, it feels like Stone Age behavior. Yeah. But our governments have more important stuff to do, I guess.
Of course. They're not going to worry about our 2 shares of L'Oreal that we want to claim back 15% dividend tax on. But I think it's an important point. I think it's the one gripe I have with, say, Swiss companies. It's harder to get back. With French, even though I'm still paying a higher tax, I know there's a way of getting it back, even though I probably don't. But at least that option is there. It's up to me whether I pursue it. So yeah, let's hope the EU get their finger out and help us along with this one. But shall we start with?
Let's start.
The boring tax bit is over. So the first company is Rubis, ticker symbol RPI. I'm going to say, is it RUI? Sorry, RUI. Rubis. And this company was probably highlighted to me a couple of times. I did a video on high yielders. This wasn't on it, but someone actually then brought it to my attention saying this is a really good high yield company. I think it's around 8%. It was solid dividend history. Actually, if you go onto their investor relations page, it's like, it has like what you get as an investor, and it quite clearly says increase in dividends over time. I was like, this is my type of company. So what do they do? So they operate in 3 main business segments overall. So they have this Rubis Energy, which focuses on petrol products, including like fuels, LPG, lubricants, and they do that across Europe, Africa, and the Caribbean, which is quite diverse, I would say, in terms of where they operate. They have this Rubis terminal, which specializes in the storage of liquid products, again, petrol, chemicals, and even some agricultural foods. And then they have this, which I kind of find quite strange, but they have the support and services segment, which has like trading, supply, shipping, and all other bits and bobs like that. But I think energy and terminal are their two main business segments. As I said, they are in Africa, they're in the Caribbean and Europe. So you're actually getting good exposure to markets that I typically would never look at, which in terms of Africa and the Caribbean, they're not so much in the US, and obviously they're in the EU as well, particularly in the renewable energy expansion. You know my thoughts on that. I've spoke about that quite a bit, and they have a way into that kind of thing. They do all this, as I said, giving you a yield of around 8%, which is
that's a lot.
Quite strong, yeah, which is quite strong. They've grown their dividend roughly over the last 5 years at around 3%, which I think is good considering they have such a high dividend yield, and they are very shareholder focused. Your worry with these types of companies with high yield is that the dividend is not a priority, or they're not going to grow. But it's nice to see 3% growth. The payout ratio is around 65 to 70%, which would tell you why it's growing quite slowly with 3%. Their free cash flow payout ratio is a little bit higher. It's 75%. So a little bit on the high side, but their balance sheet is actually quite, I would say, strong for this area. Debt equity is around 0.5, 50%, which is quite good. Free cash flow CAGR over the last 5 years is 12%. So they're growing their free cash flow quite strongly over that time. And I think it's all around a relatively stable business for one that's high yield. And in the energy business, it's quite stable, high dividends, nice cash flow growth, and they reward their shareholders with nice dividends and special dividends over time.
This is interesting, right? Because in the Netherlands, you have Vopak,
Yes.
which is a similar, well, probably not entirely similar, but that also operates all those global network of terminals and everything to store liquids such as chemicals, oil, gases. I think probably also bitumen. So that's very, very interesting, right? But that they, I think, spot a 4% yield or something like that, and this one an 8% yield. So that's a big difference. And if the company is also committed to dividend growth, outspoken, and they have a strong track record, that makes it interesting. And the yield after tax is still solid.
Still solid, and they're trading at an, let's say 8.5% PE ratio. I think that seems quite.
And cheap. Have they been hit by the tariffs then?
I haven't. Let me quickly check. I assume so. Every company has been hit by tariffs, but over the last week, no. I'm going to say no. They haven't.
No, you can see that they have been. The 52 weeks low was last November, and they've been dropping already since last year, the start of last year. So actually, the share price has been flat for the last
5 years ish, maybe.
Yeah. I would say since 2014. So it's kind of dead money for 11 years.
Dead money in terms of share price, but in terms
not in terms of yield. So
in terms of yield,
but this says something, right? It says that you probably, if you are investing in this one, there's a market cap of 2.5 billion. It's the dividend. Forget about the share price. If this is kind of the nature of the business, that the yield is the main income that you are getting, then that's why you're having it. And as long as the dividend is safe, you're good, but don't expect a growing share price. So it's not a piece of cake for everyone, right? Because most people, including myself, generally speaking, prefer a dividend growth in combination with earnings growth, and therefore also share price growth. And of course, the share price was at a certain moment before COVID around 55, 60 euros. So it could go back there again, but maybe it's more like a story of Shell. Shell has been trading also for a few decades, I believe, between 20 and 35 euros.
It'd be nice to do a deep dive on it, because there must be a story in the reason behind the share price not growing, because I've already spoke about free cash flow growth, which is strong. They have earnings growth, they have revenue growth, dividend growth. I'm just having a quick look at their margins, and they have seen, probably gross margin has seen a small decline, operating margin decline. So there's some declining in margins there. So maybe there's a reason there, but I mean, it seems like a really good income factory type of company. You get an 8% yield. The share price is not really going anywhere, and if you were to reinvest that, then that snowball would be quite.
I see what you mean. I see what you mean. Yeah, interesting. Thanks. Nice one. Nice to pick. Definitely can have a good spot in someone's dividend portfolio.
I think so.
Yeah, nice. So before we then go, of course, to the hot shots of France, I want to talk about Sanofi.
Yep.
So, you also know in our latest newsletter, I did a comparison of 15 big pharma stocks, and Sanofi is one of those as well. We have also a dividend stock card of them as part of our Dividend Talk premium service. And it's one of those, I guess, underappreciated dividend growth stocks by the wider community, but very appreciated by their shareholders. I would say it like that. Yeah.
I agree.
Yeah. So it's one of, and just for people that don't know, try the brief introduction. It's one of Europe's largest pharmaceutical companies, headquartered, of course, in Paris. Where else? I mean, come on. If I would be a company in France, there's only one place where I would like to have my office, and that's in Paris, because going there for lunch outside, nice croissant,
Yeah.
and du pain, and a little bit of vino, yeah, a little bit wine.
With those little hats on you as well.
Oh, yeah, I could see myself sitting there and then just opening up, I don't know, the French Financial Times, du jour,
Yeah.
and then
Not
look a
on
little bit at the stock prices. Yeah.
the dividend is nice.
Yeah, the dividend is going nicely up today. Yeah. Are we? Yeah, but jokes aside, they have actually three kinds of business lines, you should say. Pharmaceuticals in general,
Yep, of course.
vaccines. They have this Sanofi Pasteur division. It sounds for me like a butter one, but okay. And consumer healthcare. So if you think about pharma, the pharmaceutical part, so really the big drugs, right? We're talking here about treatments for diabetes, cardiovascular, rare disease, oncology, and also immunology. And what is very interesting is that at the moment they have Dupixent, which is a collaboration together with Regeneron.
Yes, of course.
And that's a crazy drug. They make 13 billion in sales of this last year alone. So, and which accounts for 32%, and that shows already a little bit of the risk that this company has, because it hit the jackpot. This license deal with Regeneron to be able to do all the manufacturing and everything, that was just a jackpot for them. I mean, the dividend growth was kind of sluggish. The EPS was kind of sluggish. That's why it was then at the time before they really got this blockbuster, like trading around 50 euros, 55 euros, but now it's around 89 or something like that. But hey, we don't look a gift horse in the mouth, right? It has been increasing its dividend now for 26 years. So now it's all about capital allocation. But what I also wanted to let you know is that the consumer healthcare, and don't think about Johnson Johnson or Pfizer and Kenvue of let's say what they have had in the past, like, or the baby shampoos and everything. Yeah. But for instance, they have Doliprane. Now, Doliprane may not be so well known in Ireland or such English-speaking countries or something like that, but it's the French paracetamol, right? Then you have Allegra, something against allergies, the most common ones, let's say. And then also what we get over here in Poland is non-spa, and that's an antispasmodic. So I guess it loosens up your muscles, depending on what you want to use it for, right? But there are some drugs in there that, of course, mostly they're in France and such, but they're also sold elsewhere in Europe, which is interesting because these are typical over-the-counter products that you get for a few euros, but very, very popular. So at the moment, I would say if you think about Sanofi, it's really a lot about Dupixent. It's amazing. They still have a few years of sales growth there. So their second drug name is Lantus. Just to compare, right? 13 billion for Dupixent and 1.6 billion for Lantus, which is a diabetes insulin. Yeah. So already expired. So just showing you how big the gap is. Now, when you think about the balance sheet, debt to equity, only 15%. So clearly they have been doing a good job in creating equity, but also in keeping the debt low there. And that's what we love to see, honestly speaking.
Yeah.
Now, today you get this nice little 26 years dividend growth bagger for a dividend yield of 4.37%, which is really not that bad when you think about it, and when it has the opportunity to continue growing the dividend as well. The EPS payout ratio stands at about 55%, I would say. Free cash flow a little bit higher, but generally speaking, I would say quite okay.
Yeah. Yes. Sanofi was one that kind of goes under the radar a little bit. I remember maybe it was 2020, 2021. We had some concerns about their pipeline, how they're going to get over this. But they're doing really well. What I like is about their balance sheet is there's plenty of room now that they can start experimenting to try and reduce the amount of reliance on that top drug. Dupix, how do you pronounce it?
Dupixent. I don't know if I pronounce it well, right? It's always
Yeah.
difficult with these drugs. I think it's all about capital allocation now. Like what
Yeah.
AbbVie did with the Humira expiration, that's Kinrigi and Rinvoq.
Yeah.
You have a few more of those companies that had a giant patent cliff. It's coming for them as well.
Yeah. Yeah.
So I would say if I would be advising management, don't hike your dividend too much. Do 3 to 4%. Allocate most of the cash flow that you have to improving your pipeline via R&D, but also via licensing deals. You have now proven that you can do this, and for the rest, bring down the share count.
Yeah. Yeah. I agree, and maybe some acquisitions in there, depending on.
Yeah, exactly. But it's hard to do acquisitions in the pharma space because they are not cheap.
No, and risky.
Yeah.
But I think this is a really underappreciated company, I have to say.
Yeah.
It's in the Noble 30. It's near the top, I think, is it?
I would say somewhere in the middle.
Yeah. Maybe. Yeah. Nice company. We have two that will be no surprise to anybody listening to this podcast because we speak about these quite a bit. So we might as well get them off the list straight away. And the first one is L'Oreal. And it is because we are worth it. Let's face it. That's why we like it. L'Oreal. We speak about these a lot. Every time they do earnings, we probably cover earnings. You did a deep dive on them. There's not a whole lot much more we can say about the company. We know that they are the largest cosmetic and beauty company in the world. Everybody will have at least one of their products in their homes. I mean, everybody will have some. They have probably unmatched global reach, pricing power. They had a little bit of a wobble with the troubles in China over the last year, but that just presented probably a buying opportunity for them. They have consistent growth, high margins, and a really strong balance sheet. So, I mean, we're fanboys. You have some shares, I believe. You have one or two shares.
Yeah.
With the tariffs, is it interesting you with these guys? Did they get hit at all?
I mean, I don't know. The share price, not really, from what I've seen. But I mean, if your lipstick gets more expensive at 10%, would you stop buying your favorite lipstick?
No, I still need to look good.
Exactly. It's as simple as that, I think.
Yeah. And look at their brands, their billionaire brands that they have. Lancome, L'Oreal, Maybelline, Garnier, Saint Laurent, I'm definitely saying that wrong, Armani. I mean, they're just really strong brands, aren't they? Like brands that everybody knows and loves and wants. So, yeah, not much more to say about them, unless you have.
No, I mean, really not. I would just say, like, what is important for people to know: if you own a stake in L'Oreal, you're not alone, of course, but François Bettencourt, the lady, she owns 35% of the business.
Yeah.
So you're dealing here with a family business. Some people don't like it in the sense of, okay, but means that others don't really have a lot to say because Nestle owns the other 20%. So if she makes a deal with the CEO of Nestle, all the others are offside. Yeah. On the other end, they are very much invested in the future of the company as well. And founder-led and family-led businesses usually think really long-term, which we appreciate as dividend growth investors as well. I think that's the only disclaimer I would say when thinking about L'Oreal here.
Yeah. One thing we haven't said is if you are a shareholder, and I don't know if you've done this or not done this, but if you're a registered shareholder, you are entitled to a 10% bonus on your dividend checks. Is that something that you have done or will do, or will you wait till you have more shares?
Yeah, but I would need to register it properly, right? And I haven't tried it yet, actually. As such, I don't own them so long either, so maybe I should try. I hope it works. I hope that, for instance, a share that did a hero is also making it eligible. Probably not, but maybe let's try it. Let's check it out.
Yeah. I mean, I say free, but it's 10% right on the table. So why not? go for it. And the second company then obviously is Louis Vuitton, LVMH. Again, a company we covered in great detail. They're trading at around a 1.85 dividend yield at the moment, which I think is quite decent for this type of company. It's below my threshold, I must say. But they make whiskey, or Hennessy's whiskey, and they make fashion. And they have champagne.
185, you're looking at old data, my friend. The current dividend yield is 2.5%.
You are right. It is 2.5%.
Yeah. So for me,
2.5%. Wow.
Yeah. Not too bad, right? For this little beggar.
That's actually getting close to. I mean, that's getting close to being very interesting. Actually, normally 2.75, but I could definitely swing for 2.5 for Louis Vuitton. It's I didn't think it would get there. It wasn't so long ago. It was trading under nearly close to 1, was it, or something? It was trading quite high, but again, you're a shareholder or not?
Yeah.
You're a shareholder. So they did have a slight dividend cut in 2019, but French companies were under a lot of pressure back then to cut their dividend, if I remember. And they've more than made up for that since. Again, look, we cover this quite a bit. We don't have to cover it in more detail. I think they have a really strong portfolio, brands that everyone knows. China, again, was their main hiccup, which is probably driving the share price down over the last 12 months. But now trading at a really attractive yield, and a 5-year dividend CAGR of over 20%. So it's definitely one for the watch list. And I think everybody should maybe have a piece of this in their portfolio.
Yeah, and it makes it interesting, right? Because the 5 stocks that we're discussing, if you take them all together, you probably end up with a 5%, 4.5% yield, with quite some quality in your portfolio. Some will be more higher growth, other will be higher yield, lower growth, but will give you a really nice mix. So, because the 5th stock that I want to talk about is, we have to do it. You know that I like them black, right? And once you go black, you never go back, they say. So that applies to coffee, but that also applies to oil and gas stocks, as you may know. So for me, that's TotalEnergies, and it's a very interesting company. It's one of the largest largest integrated energy companies. So typically, what they say, part of the big 5. So you have ExxonMobil, Chevron, Shell, TotalEnergies, and BP. Let's say, those 5 are probably the top 5. What is interesting here with TotalEnergies, it's one of those that is still a lot on renewable energy. And they own also quite some electricity, or generate also quite some electricity, which is interesting, because if you want to have a little bit of a hedge in climate change and look for oil company, I think something like TotalEnergies and Equinor are still kind of giving you that a little bit, because Shell entirely ditched it, right? We could say.
Yeah.
And BP, I believe as well, they also said like, well, remember green energy? They also said like, we like it black. Yeah. And like I said, once you go black, you never go back. Some people may then afterwards, still try something out, but they will always come to the conclusion about that. So, and there have been years and years of dividend growth as well. Technically, you could argue that a few years ago they had a dividend cut with 1 cent. I don't know why, but they did a 1 cent reduction. I didn't throw them out of the Noble 30 for that reason, because it was like a 2% cut or something like that. I see it more like a typo that they did, and then probably thought like, oh shit, we can't turn this back. It's official now after the announcement. So that's how I look at it. It's of course not a growth stock. It's really, I think, like Rubis, for income-focused investors. But it has a strong balance sheet, my friend. Really, and also the CapEx, the OPEX that's coming in, the operational free cash flow. They still have like a lot of proved oil and gas reserves, so they can still go along 11 or 12 years if they would not replenish anything, which is good. This is something that you need to look at. They had really good reserve replacement ratio, so they were replacing more than that they were consuming in 2023, as an example. So They pay about, let's say, 8.5 billion in dividends. They have been paying equally buying back shares. So I mean, I would choose still Shell over this one. I think Shell's more aggressive in its shareholder return. But this company is offering you now a 6.6% yield, and I would say it's probably fairly valued with all that it's offering.
Yeah. There's a couple of companies that when you speak about, you have this little twinkle in your eye and you get really, I don't know, I hope everyone can hear the passion in your voice talking about them. And I remember when you did the comparison of all the oil majors.
Yeah.
Remember you did that? And you were just finished. You just said, "Hey, Derek, can you jump on a call for a few minutes?" And you're like, "Look at TotalEnergies. Look at this. Look at this." You were so excited about them.
But I don't own them. Because the simple fact is that I've got too much oil and gas in my portfolio.
Yeah, which is a shame because they look, as you said, they look like a really well managed business. And again, they are in this energy renewable space, which I like. They have significant investments in, I think, solar and battery, which is becoming really well. I don't know about the rest of Europe, but in Ireland, this is becoming really strong. So yeah, it's definitely a company to look at, I think.
I've been sometimes thinking of improving the yield of my portfolio, but by just selling ExxonMobil and buying TotalEnergies back for it. But
yeah, the tax bill is probably
no, it's not the tax. In the end, really bottom line, TotalEnergies is still a French company. So, and I would never bet against America when it comes in terms of oil and gas. And ExxonMobil has really shown strength during COVID. The dividend has not been growing a lot. And I think with Shell, I have enough exposure to European politics with Shell, let's say.
Yeah, I get you. But look, as your portfolio expands, there'll be room for more oil and gas, and they'll be waiting.
At a certain moment,
they'll be waiting for you. But look, I think I really like your approach that you spoke about before in terms of high yield and low yield, buying them together to give you an average yield. So you take someone like TotalEnergies and put them with Louis Vuitton. You're still getting an average yield of about 5%, but two good companies.
And what do you think that oil and gas engineers use when they travel like expats all around the world?
Louis Vuitton bags.
The Rimowa suitcases, because they're very solid and they can afford it. So
yeah. So there's some good companies there. And hey, like we said 10 at the start, there's 5 companies that we haven't looked at, but I think are worth mentioning. I looked at some of these before in preparation for this, but one of them is Arkema. I think that's Arkema, which I've never heard of before. But they have a really strong, I think, 20 years plus dividend, solid growth. Groupe SEB are there as well.
Groupe SEB,
Groupe SEB are strong. Obviously, Pernod Ricard, Sodexo, and Pharmagist Interactive. And all these have really strong dividends. Some of them have cut it, I would say, in 2019. But they've been strong growth since. So I'm not penalising French companies for 2019 or 2020 because they were under a lot of pressure at the time, if I remember. So 5 companies I would also add to your list to check out, and maybe we might do stock cards or look at these a little bit more.
Exactly. Good. Well, let's go then to some of the listeners' questions. I think they're waiting for that as well. And it's always nice to get all these questions already. For 242 episodes, we're getting questions from listeners. Isn't that amazing?
Yes.
We must have had over 3,000 questions already from our listener base.
Easy. At one point, I remember we do our end of year reviews. I tried to go back over and try and get all the questions and sort them. I got through about 4 or 5 episodes. It was too many. I was like, I'm not doing this. I need a more automated way to do this. I'm not doing this. But we do love all the questions. So let's start with dividend controller. And you notice I use the English name and not the German name, which I absolutely
Swedish or Danish.
I normally butcher that name. But he's asking, is there any one thing that either of you have learned from the other or something you admire?
What I admire is your knowledge about engineering. So anytime when I'm looking at engineering companies, I really rely on your industry expertise.
Your discipline has been really helpful for me. And I remember 2 years ago we did a presentation of our goals, remember?
Yeah.
And I had stuff in about options and all this, and you were like, Derek, take that out. Very Dutch direct, I would say, but like, you don't need this nonsense. You stick to the plan. Your plan is dividends. Show me your plan. Yeah, stick to that. Get that garbage out. But I mean, your discipline has been, it's amazing how sometimes, like, I know you sold Apple, but there was times when I was saying to you, would you not just sell that straight away and buy like this high yielder? And you're like, no, you just have the right discipline. Or ExxonMobil was a great one. Remember that?
Yeah.
You had the discipline to hold them and to not
I
panic.
was very much doubting at the time.
Yeah. But you still had your rules, had your discipline. And I mean, I see your charts on how you progressed. It works. That's all I'll say.
Yeah.
It works. Yeah. Alexandros has said, how is your most important investing body organ these past 2 weeks?
Where does it sit? Is he talking about this thing that typically looks like the nose of an elephant?
I'd rather it beats. I don't know.
Oh, you mean, okay, that one. Okay, you see where my mind is.
Yes. Get out of gutter. But
What a question.
we spoke about this, I think, early in the show.
Yeah.
I've been so busy, I haven't even had time to think about it. So it's all good. It's all good. My heart's still beating.
Awesome.
Look, we'll skip your answer. Philippe has said, what will you look for in the upcoming earnings report, given this will cover the last period before tariffs? Any specific area you would focus your attention on more?
So I will always focus on the same stuff: free cash flow development, sales development, all these kinds of things, right? But I will pay particular attention to the guidance here in terms of tariffs. And I may hope, but I'm afraid that not too many CEOs start to use the term laser focused. We will be laser focused on our inventory management. We will be laser focused on keeping our working capital in control. We'll be laser focused on making sure that we shift our manufacturing to a laser focused environment. Yeah.
Do you know what I'll be looking for is, it'll be a major red flag for me if anyone uses these tariffs as a reason for a poor performance last quarter.
Oh, yes. Yeah.
And they might think that's an easy win for them to say, oh, tariffs, but they only took effect at the very, very, very end. And at that, was it for a couple of days in European or something like that? So if anyone is blaming that now for their past performance, to me, that's a red flag.
But only because some of them will, because they've been front loading inventory.
Okay.
Yeah, if you've been buying all the inventory you could, so that means that your free cash flow, your working capital goes up, your free cash flow goes down, and then the next quarter you will see the free cash flow go up again.
Yeah,
we saw that also during COVID, right? Those supply chain shocks, but that's the only out of jail card, because that would be good management, right? To think like, you know what, let's front load some inventory.
Yeah, that actually makes complete sense. And I think about my own company. We have a US business, and I'm in the middle of like this FAT. They had to not even speed up, they had to cancel it and ship everything before these tariffs come in, because it was going to cost millions. So yeah, no, that makes complete sense. But my point is still valid. If they're using anything else as, oh, tariffs made us lose this much money, this much revenue, to me that's a red flag. They're looking for an easy out. They're not telling you the truth, and move on.
Exactly.
Brian has asked us, when you are assessing how much of your portfolio is allocated to an individual stock, do you look at the total value of a stock as a percentage of your overall portfolio value, or total income of a stock as a percentage of your dividend income?
Yeah, I understand why. Because sometimes Microsoft, for me, for instance, is a number 2 position.
Yeah.
But somewhere near the bottom in terms of dividend income. And then you have legal in general, which is probably somewhere in the middle or to the bottom 50%, and one of the highest in dividend income.
Yeah.
So I look at both. Simple. I think you need to take both into consideration. When I think about my 4-tier system, I also try to look at both. It's not always perfectly possible, but it gives you a feeling of direction.
Yeah, but is there one that would give you more weight over the other? For example, let's say Microsoft.
No, it would be more in terms of dividend income, because that's what I need to live off.
Yeah.
So that puts, I guess, the heaviest weight in that case. So I want to watch out that, for instance, not legal in general cuts the dividend and suddenly I lose, I don't know, 10% of my dividend income, which is not the case, but hypothetically, right?
Yeah, we get
That
you.
hurts more than if Microsoft will be 2% and cuts the dividend by half.
Yeah. I do look at both as well. But when I think about how I look at it, I always look at it in terms of stock as a percentage of my portfolio value. And I think that I actually don't think that's right. I think it should be the other way because,
Yeah,
like you
so
said,
that's what I'm more doing. Yeah.
dividend cuts can and do happen. So,
Yeah.
David has said, when you see a sale happen like last week, do you deploy more cash to invest?
No, not really, because I don't have it.
Yeah,
My cash is spent. So
Do you know what? Like I was thinking about this the other day. I was like, how did I have so much when COVID happened? And then I remembered we didn't leave the house. We had nothing.
exactly, we had more to spend.
We had like didn't spend any money, so that's why it was able to just gather up and up and up and up, and you could deploy it all into the stock market. Because I was like, I had a decent war chest for COVID, and I deployed that reasonably spread out. I would say. This time I don't have any war chest or anything. It's just like I'm just sitting here waiting for my wages to come in. Come on, the market is down. I want to buy. So yeah, no, I don't have cash to invest. If I did, even in these last 2 weeks, I think I would not be in a rush. I think I've said this a few times.
No, I'm also not in a rush. I think there could be more to come. And if not, it can be easily again that in 5 months from now we think like, oh, remember this tariff crash?
Yeah.
I wish I bought more. Yeah.
Yeah, but then like I go back to COVID, like we're buying oil stocks at the time.
Yeah.
And I remember you saying, come on, are people not going to drive cars, or are people not going to fly airplanes and all these things? So we kind of knew at the time that that was temporary.
Yeah.
This, we haven't a clue. We haven't
No,
a clue.
but I'm starting to develop my thinking here as well, because you see now again with laptops and iPhones, being exempt then for this for now. At least that's the latest news. Let's see what it is later tonight again. I don't think the government there will allow suddenly the iPhone to be twice as expensive without salaries going up.
Yeah, and then we're in a whole nother mess.
Exactly.
It's a dance with the Fed. The Fed, at some point or another, will have to make a decision on interest rates.
Yeah, but if inflation goes up, usually it would raise the interest rates.
Exactly.
That's the opposite of what the administration wants. So.
Exactly, and then we're in a whole world of other trouble.
Exactly.
So let's see. But to my point, it's just so volatile at the moment.
Yeah.
I just nice and calm.
Yeah.
And calm. Jan has said, do you use technical analysis for determining when to invest for the long term?
No.
Sometimes I used to way back.
Tried.
Look at the like 200 moving average, and it was close to that. But
I tried. I felt a lot smarter when I was doing that.
Yeah, but honestly, I look at my valuation models, and if it's
below, then it's fine.
Exactly. If it's below that, then it should be close to.
What I learned over time is that you want as little as distractors as possible, taking your focus away from what you really want to do. I just want to buy passive income. So let's say income at a reasonable price. Anything else is a distractor to that. So you need to establish what is a reasonable price, and you need to figure out if the income is acceptable and safe. Yeah. So all the rest is just noise to that investment decision.
I mean, it could be useful for deep value investors, so that just focus.
Yes, and that's why I've been playing around with that. But what I mean, why I'm saying this, imagine now that you say like, oh, but it's 5% above the 200 daily moving average, and therefore you don't buy it. Yeah, and then you missed out the whole opportunity.
I'm going to give Microsoft as a good example of that. Remember, they were trading at 185 or something, and I thought they were overvalued at that time, and now look at them, they've doubled in price. So you can bet your bottom dollar they weren't trading at a 200 moving average below that. So
Yeah. So there's a place for this. Don't get me wrong, and I also believe that technical analysis works. Yeah, I think there's a place for that, but there's only so much information you can consume. There's only so much knowledge you can build in your circle of competence, and once you go into the technical analysis world, it requires a whole new level of understanding, and then there's opportunity cost. Do you want to spend time learning that versus the added value it gives you as a dividend growth investor who's mostly focused on buying income, safe income?
And I mentioned my admiration of discipline for you, but you need plenty of discipline.
Oh, yes.
And consistency, which I find tricky because you get your judgment gets clouded. I mean, your rule might be, it has to be below the 200 movement. I keep saying 200. It doesn't have to be that, but it might be has to be below this and coming up. But then you might really want the company, and you might start. Maybe if I check the 180-day moving average, and you might just keep changing it to suit your narrative. So look, I think whatever you do in terms of technical analysis, just be consistent, be disciplined. And as you said, I personally don't use it, but I know people that do and do quite well. JVDK is reading the income factory right now, but as a Dutch guy, they cannot invest in CEFs or closed-end funds. Stephen Bavaria would never invest in a single stock as it's too much risk. But what is your take?
So I believe you can get them at Trading 212, some of them. So it depends probably on your broker as well. Other than that, I understand what he means with CEFs, right? I look at it more as the income factory, like the high yielders that you think will not cut the dividend, which can really boost the income in your portfolio. And you know, if you have a 6-7% yielder and it grows still by 4 or 5% each year, you're quickly on a 10% yield of cost. And think about ASR Nederland and then Group. Those are high yielders. They also classify as dividend growth stocks. Then you have Legal & General, another insurance company. We just spoke about Rubis. Yeah. There are a few of those. Omega Healthcare. Hasn't risen the dividend for many years, but gives you an 8 to 10% dividend yield over time. Yeah. So I see it more like that. And the power of the income factory is reinvesting that at a high rate. And that's where the compounding then comes from.
Yeah, I think it's the principle behind what he is saying rather than implementing his exact strategy on buying certain type of CEFs. And I don't know about Trading 212, but what I can tell you is that when I read the book, I was able to invest in these type of funds in Interactive Brokers, but they stopped. I think I was doing it for about 6 months, and I'm not able. I still hold some of them. I don't want to sell them. They're a relatively small part of my portfolio, but I can't buy any anymore. I can just sell them. But like you said, you got single stocks, but you've also got investment trusts in the UK that you could use in a similar fashion. So I would maybe take the principle of what the book is about rather than exactly what Stephen is saying, because we are Europeans and it is a little bit different for us over here. Daniel has said, how does the risk reward for Shell at current prices compare to the 2020 crash? Under what circumstances would you consider increasing your position?
So let's say that in 2020 crash, I was looking at 20 euros. Well, they reduced the share count by more than 20%. So I guess for a nice back on the napkin, 24, 25, you will have a similar, I guess, earnings or free cash flow yield as then under normal circumstances. Yeah, you need to really take the buyback into consideration from then. So but this is a back on the napkin how I look at it. I don't know what we have in our premium service as a fair value price. That's more for the members there, but that's kind of back on the napkin how I look at it.
Yeah, it's probably what's sitting at 26, 27 euros. So it's probably close, I would say, to what I would consider fair value. Trading close to 5% yield as well, which is not too bad. But yeah, I think if I was to look at oil again, I would, because I have Shell. I don't have anyone else. So if I was looking in that, I have EOG resources for that. That's different. I would look at one of the others as well. Maybe not so much Shell. But yeah, I think anywhere around, I think right now it's close to fair value. If it drops to 24, 23, it's definitely worth buying. But I think 5% yield, I think, is fairly good considering how much they buy back their shares, considering how much they pay in dividends, considering how much they're paying down in debt. I think it's trading close to fair value, in my opinion. So
Yeah.
But I prefer to buy oil. I know you're similar. When everybody is telling me oil is dead.
Exactly.
And there was another part of that. Johnny had asked probably a similar question. Shell, if you did not have a position, would you establish one at the current prices? And I think we kind of answered.
Yeah, we answered that.
Yes, is the answer. And then we've got two questions on Texas Instruments. The first one is from Alexander. What's your view on Texas Instruments right now? And then the second one is from Yedia. And it said it's getting hammered lately because of tariffs. Do you still have conviction in its long-term growth and potential for sustaining dividend growth?
Yeah, nothing changed. Generally, my conviction about stocks didn't change really due to the tariffs. Yeah, I mean, people will need their products. They'll have to pay more. This will have to be passed on to the consumer. Why would I change my thinking about this? I'm thinking decade long. Yeah. So if something happens, they'll figure it out. It doesn't apply only to Texas Instruments. It applies to the whole industry. And we will see the upcoming earnings reports if there's really something to be worried about. So I'm from Tara's point of view, I'm not changed. I've not changed anything in my perception right now. Let's see how it plays out. Also, Trump may play hardball in the beginning to get everyone on the negotiation table, and then we'll see. I mean, there's just a lot of noise right now. Fundamentally, I can't judge if these companies have fundamentally changed something. For me, the biggest risk is not so much Texas Instruments or the tariffs that the US is putting on countries. For me, the biggest risk that I see is, for instance, more with the companies, US companies that sell a lot in Asia and in Europe, where there comes an anti-American sentiment, which may lead to shifting consumer behavior. Going, let's say, instead of buying Nike, let's buy Adidas. Yeah, let's take the Europe, and then they get used to their products, get more exposure to the products, may stick around longer with those products, and before you know it, some of the American equivalents are forgotten. Think about Starbucks. Yeah, that you see this activism. That's if there's a slight worry that I have that tariffs can do, it's more that than the actual tariff itself.
Yeah, I think Texas Instruments was under pressure before tariffs. They're in this reinvestment cycle, which is kind of hampering their free cash flow, but they forecasted this. Obviously, they've had troubles with China, the Chinese market. It's before all the tariffs, so maybe the tariffs are just giving it an extra excuse to push it down. But I mean, I agree with you. It's too early to say, but it's one to definitely. I think more so with Texas Instruments, based on where they are in that reinvestment cycle, how much free cash flow they've left over to pay their dividends. I think it's definitely one to watch. But I mean, it's still way too early. It's still way too early. And you said semiconductors are going to be left out of tariffs anyway, so it might not impact them at all.
Yeah, exactly. Let's see.
Who knows? Richard Taylor has asked us about LYB. I know you spoke about these recently, but have you added them to your portfolio, as it is near a 10% yield with a good dividend history?
Yeah, I added, it's really a few, just like 4 or 5 shares the other day. So it's like really not a lot in terms of my portfolio. It's like a dust of sand. But look, simply said, a bit of a riskier dividend, borderline safe, maybe, let's say it like that. So it's clearly, for me, one of those high yielders, like we just spoke about, more like an income factory stock.
Yeah, I think so. It's a company I'm always skeptical of because they went bankrupt, cut the dividend, and it's always in the back of my mind. Obviously, the Ukraine hit them as well, and I find chemicals a tough business to analyze.
Yeah, we saw it with BASF.
Yeah, BAS and APD as well. So I don't have them, but you do. Eran has asked us about Viola, VIEP. They are on his radar and asking if we ever looked at them.
Yes, of course. These are the ones that when I walk through Warsaw, I see, even on the sidewalk, I see the Violia brand. When you walk over it, how do you call it? A putt? How do you call it? This things in the sidewalk where?
Oh, we call them manholes.
Yeah, manholes. So you see those covers, but I just don't remember anymore, and I just never bought them. And it could have been one of those French stocks we could have discussed today as well.
Definitely.
Generally, I remember it was a good, high quality company. I just don't remember anymore from dividend point of view.
David has asked us about a Finnish company called Hotamaki. They have a great dividend history.
Oh.
So they sound familiar to me, and I knew why, because I just looked them up there. But they are a packaging company, and I remember looking up Smurfit Kappa, who are now Smurfit West Rock, and these obviously are in that area. So look, I haven't looked at them. There's a lot of Finnish companies coming up lately, but I think I prefer to stick to Sunoco products and to Smurfit Kappa or Smurfit West Rock. So not for me, but I can see that there's definitely a place in someone's portfolio. They do have a really strong dividend, but I just didn't look at them deep enough. I prefer to stick closer to home. And then the last question is from Giuseppe. And have you ever looked at MSCI and compare the company to Moody's and SPGI? I haven't, but it's something I want to do. I mean, there's 3 really good companies there, what we would call compounders, I would say. And they are on this ever growing list of companies to look into, but it is one I want to do. I like this sector a lot. It's quite strong. So it's on the list. And that is it. That is all our questions. Thanks to everyone for listening. If you're on Spotify, YouTube, please like, subscribe, rate. It does really help. We appreciate it. And we will see you all next week. Remember, both of us at Dividend Talk are not certified financial specialists through formal education. We are just 2 guys sharing our journey for inspiration and entertainment purposes. Hence, this is not investment advice. Although we do our best, we can't promise that the information discussed is always correct, nor appropriate for you or anybody else. We always recommend that you do your own due diligence and be accountable for your own choices. As we always say, you can't borrow conviction from others. Last but not least, by listening to our podcast, you agree to hold us harmless from any ramifications, financial or otherwise, that occur to you as a result of acting on information provided in this podcast.